Recessions, we all cringe just hearing it. It's the R word. But yet, aren't recessions an integral part of the long-term health of any economy?
You're 100% correct, Rick. The reality is recessions are, as we talked about earlier, therapeutic. There are two types of recessions we got to worry about. One are real sector recessions. The other one are financial recessions. Real sector recessions are short, shallow. They're 1, 2, maybe 3 quarters long. Financial recessions are deeper. They're longer. Why? Because it takes a while to correct balance sheets. But those imbalances that accumulate over time have to eventually be cleansed out of the system. And that's why they're therapeutic. And at the other side of the rainbow, we tend to come out of them. And therefore, they tend to be more market opportunities than they are disastrous opportunities.
You know, Stephen, I don't know if you got to hear Byron Reams, a favorite of CNBC and mine. He brought up an interesting point. Since the Great Recession, debt has quadrupled, but yet servicing the debt is only 25% higher. You know, I know that the Fed, in a way, just stating that is actually putting a lid on a recession. Wouldn't you agree with that?
Well, I think there are 2 points that you're bringing up. One is the fact that the reality is the Federal Reserve has been an important influence behind the recovery that we've gone through and now the expansion that we've gone through. But the point against what Byron was talking about, the reality is if the Fed hadn't expanded the balance sheet, we would be looking at deflation. And deflation is the worst thing in the world, the largest net debtor in the world should ever face. And therefore, what the Fed has done has been 100% appropriate. It is not inappropriate. And therefore, looking at it as if there's something wrong with what the Fed has done in its balance sheet just puts the wrong cast on the scenario where the Fed created the best opportunity for this economy to continue to grow in an environment where many other people are facing deflation. We're not, and that's an important difference. And if we were facing deflation, this equity market, the bond markets would be at much lower yield levels, and the equity market would be at substantially lower valuations.
And it's a great argument, and it's hard to disagree with, except for we haven't finished the back half of the book, and maybe stating what is preferable might be better known after it ends. Finally, very quickly, we're almost out of time. What do you peg the chances of a recession in the next 4 to 8 quarters?
Oh, minimal, less than 5%.